Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Welcome to Fitch Ratings Fixed Interest Podcast. My name is Justin Patrie. Our topic today is emerging market credit and how emerging market issuers are faring in 2025 amid slowing global growth, persistent geopolitical risks, and significant policy changes in the U.S. And to speak to this, I'm very pleased to be joined by Duncan Innes-Ker, a Senior Director in Fitch Ratings Credit Commentary and Research Team, who is based in Hong Kong. Duncan is also the author of our quarterly China Credit Brief report and co-author of our recently published Global Emerging Markets Credit Brief. Welcome, Duncan. So let's start with emerging market credit ratings. How have they been performing in 2025 so far?
Yeah, I think one of the main themes for emerging market credit so far this year has really been the resilience of ratings in most parts of the world to the fallout from the US tariff hikes. Upgrades in most of the world over the first half of the year among our emerging market issuers were slightly outnumbering downgrades, continuing the trend that we saw last year in 2024. Now, part of that's been driven by sovereign upgrades in places like Nigeria and Argentina, where reforms have reduced the risk to macroeconomic stability. These sovereign upgrades then in turn contribute to the upgrades of other credits like banks, where sovereign support is key, or where the sovereign rating has constrained the rating of other issuers for various other reasons. Now, I've said that the overarching picture is a pretty positive one, but there is one major exception to that, and that's in China. Fitch downgraded China to A in April 2025, and that directly led to the downgrade of around 95 sovereign-related credits across various sectors. Now, the sovereign downgrade itself reflected our expectations of a continued weakening of China's public finances, with rising public debt as sustained fiscal stimulus is deployed to support economic growth amid a backdrop of subdued domestic demand, rising tariffs, and deflationary pressures. So that, along with some ongoing structural erosion to the revenue base, is likely going to keep fiscal deficits high.
Back in June, Fitch reviewed and updated its 2025 outlooks for mid-year. These outlooks reflect our views on the relative direction of economic and operating conditions for hundreds of sectors. What did that analysis say for emerging markets?
Despite the resilience of the global economy and capital markets in the first half of the year that I just mentioned, we're still quite wary about the potential for greater fallout from the US tariff hikes and the potential for tighter financing conditions globally in the second half. Our sort of underlying assumption is that the macro credit outlook is pointing to deterioration ahead as the US tariffs take effect and as global demand growth slows more concretely. So that's been reflected in a significant shift in our mid-year update of the outlooks for sovereigns in the regions of APAC, Eastern Europe, and Sub-Saharan Africa. And those outlooks all moved to deteriorating from neutral. And we also maintained the deteriorating outlook that we had for Greater China sovereigns that we had at the start of the year. Now, by contrast, sovereign sector outlooks for LATAM and the Middle East and North Africa remained at neutral, which partly reflects the fact that those regions are less exposed to the tariff risks. Now, that's the sovereigns. If we look down a little bit into other sectors, you've got emerging market banks. Now, those are mostly resilient. The outlooks for those on the whole were mostly maintained. However, during the mid-year update, we did revise some outlooks to reflect weaker prospects for loan growth, asset quality, and profitability because of US tariff trade exposures in some markets. So that affected the sector outlooks for Korea, Mexico, Taiwan, and Thailand, which moved to deteriorating from neutral. And it also led us to change the sector outlook for Vietnamese banks to neutral from improving. We also maintained the deteriorating outlook that we had on Chinese banks. Now, our projections for corporates were generally more stable. So for corporates in LATAM and emerging EMEA and APAC, we have a sort of projection of broadly flat total revenues or slightly contracting in some regions. But we do expect that EBITDA margins will remain pretty resilient, and most corporate sector outlooks remained neutral for 2025 during the mid-year update. China was again something of an exception on the downside, with 8 sector or asset performance outlooks on deteriorating And that again highlights the challenges in China to companies' financial performance amid the higher US tariffs, the lingering property sector downturn, and persistent deflationary pressures.
You talk about deterioration in our projections and forecasts. Can we just tack down specifically our economic growth forecasts in emerging markets? What's the trend, and what are some of the specific numbers for the largest EM economies?
Yeah, so overall, we're projecting that emerging market growth should slow to around 3.7% this year from 4.5% last year. So that's a fairly significant slowdown. We're expecting India to remain the fastest growing emerging market and indeed the fastest growing large economy with growth of about 6.5%. And China and Indonesia both comfortably over 4% growth, while you've got sort of a bunch of other large emerging markets like Brazil, Turkey, and Poland, all growing in the sort of 2.5 to 3% range. Now, if you look at sort of the less strong end of the spectrum among the large emerging markets, South Africa is set to post pretty subdued growth by EM standards at 1.2% this year, although that will still mark a bit of a pickup from the very weak performance that they had last year. We're also expecting Mexico's economy to shrink by 0.1% as a result of the hit from US tariffs. In general, as I mentioned earlier, we think year-on-year growth will be significantly weaker in the second half than it was in the first. But as we look to 2026, things should begin to recover a little bit of momentum next year.
Duncan, you write our quarterly China credit brief report, which outlines Fitch's key cross-sector views on Chinese credit. You mentioned the sovereign downgrade back in April. What's the big picture story there in China and also for the broader emerging markets region in APAC?
We saw a bit of a pause in the US-China trade actions in the last quarter in Q2, and that kind of was meant to allow room for negotiations to move forward. But we still don't really know what the final tariff arrangement is going to be between the two countries, which leads to a lot of uncertainty. And even if you take the current status quo where things have kind of eased up a bit, by our calculations, the effective tariff rate on China as of June was about 37%, and that was the highest of any US trading partner. So there's room for things to kind of sort of remain pretty tough for Chinese exports to the US. Now, China's economy has held up pretty well so far against the trade war stress in the first half of the year, but it's by no means out of the woods yet. And some of the economic data from the last month or so is pointing to a little bit of a loss of momentum. The government's efforts to kind of support the economy remain fairly incremental and calibrated. So things are essentially pottering along, perhaps a little bit better than we'd expected at the start of the trade war outbreak, but there's still a lot of uncertainty in the air. And I mentioned earlier that 8 sector outlooks for China are deteriorating for 2025. And sustained weakness in the housing sector is a key driver for a lot of those, including China real estate, home building, and engineering and construction. We actually recently revised our projections for China's property market to reflect a better performance than we'd expected in the first half of 2025. But we still see a drop in new home sales of 7% this year. So that's by no means a strong recovery or even a stabilization. Outside of China, the cross-sector picture is more stable in Asia, and much of emerging APAC continues to enjoy strong growth, and that's providing important support to revenue growth prospects and credit profiles for issuers in the region, even with the hit from tariffs.
You mentioned Latin America as one of the sovereign regions where our regional outlook is neutral and not deteriorating. Can you quickly sum up our outlook for credit there?
The outlook for credit in LATAM has not really shifted meaningfully since the start of the year, despite all of the volatility around US tariffs and US foreign policy. And I think that was highlighted recently by the very high tariffs that the US has imposed on Brazil. And basically reflecting that most of the 2025 sector outlooks for LATAM, including those for sovereigns, corporates, banks, and insurance, are all neutral still. And only non-bank financial institutions have a deteriorating outlook for the year. And that really reflects weaker conditions in some subsectors in Mexico and Brazil, potentially increasing the risk for financing and leasing companies. Thinking sort of more broadly within the region, Mexico has the greatest direct exposure to US protectionism, but the effect in other countries and their issuers should be less significant. If we take Brazil as an example, all but 4 of the Fitch-rated Brazilian corporates have less than 10% of their revenue coming from trade with the US, for example. When we look at that market, it's really high interest rates and not US tariffs that remain the main challenge for Brazilian corporates. We mentioned earlier, like Mexico and Brazil are expected to see growth decelerations this year, but as a whole, the region should post pretty similar growth to 2024 at just above 2%. And that's not particularly fast by historical standards, but it is sufficient to stave off a major regional credit pressure. In aggregate, corporate issuers also tend to have leverage headroom relative to their negative rating sensitivities, and effective balance sheet management is also limiting the risk of systemic rating downgrades.
And finally, what about Middle East and Africa? That's another region where the sovereign regional outlook is neutral and not deteriorating.
Middle East and North Africa, it remains neutral indeed. And that's basically around the direct US tariff exposure being relatively limited for the region. Now, they are exposed to indirect effects, of course, for example, through the impact of weaker global demand on commodity prices. And the extent of the fall in oil prices will be quite important for credits, particularly in the GCC region, where we think that the fiscal policy response to lower oil prices risks hitting growth momentum in non-oil sectors. If we're looking sort of towards the southern region of Africa, as we mentioned, the sub-Saharan African sovereigns is deteriorating, and we think that sort of cuts to aid flows in that part of the world will put unwelcome additional pressure on some countries' fiscal positions. But still, there may be some support from the weaker US dollar, which tends to ease the foreign currency debt repayment burdens for people with a lot of US dollar denominated debt.
Well, thank you very much, Duncan, for that whirlwind tour around global emerging markets. And as always, thank you very much to our listeners and subscribers. If you would like to learn more about Fitch's credit ratings and analysis, please visit our website at fitchratings.com.
Subscribe to Fixed Interests wherever you get your podcasts.